Welcome to CPA Australia's webinar, Climate Risk, What External Auditors Need to Consider. My name is Claire Grayston and I'm the Senior Manager for Audit and Assurance within Policy and Advocacy at CPA Australia. We have people joining us from all over the country and also overseas for today's webinar. I am speaking from the land of the Wurundjeri people of the Kulin Nation. So I'd like to take a moment to acknowledge the traditional owners from around Australia and pay my respects to elders past, present and emerging. I extend this acknowledgement to all Aboriginal and Torres Strait Islander people who may be joining us today. I'd also like to acknowledge that today we'll be joined by CPA Australia's board members, Merrin Kelsall, President and Chairman of the Board, and Rick DeSanti, Deputy President. Thank you both for joining us, Merrin and Rick. It's now my pleasure to introduce our presenters. Dr. Nick Wood. You feel free to turn your cameras on as I introduce you. Dr. Nick Wood is the Director of Climate Policy Research and an Associate at Energetics. He'll provide us with an introduction to climate change science and the climate risk faced by companies. Next, we'll hear from Terence Jararatnam. Terence will be joining us shortly. He's a partner with Climate Change and Sustainability Services at EY, and he'll talk about how to assess the impacts of climate risk. That'll be followed by a presentation by Caitlin Bonato, Director of CFO Advisory, that is Financial Reporting and Sustainability at PwC, as well as Amanda Campbell, who's a partner of Assurance at PwC. They'll be speaking about climate change and financial reporting and the auditors' considerations. Following the presentation, I'll host a panel session with our 4 speakers, and at that panel session, the speakers can address your questions. Now, please do submit those questions throughout the presentations in our Q&A box and direct them to all participants so others can see what's raised, and we can provide links or written responses if needed, but we'll certainly try to get to those in our panel session at the end. Any troubleshooting queries, as Melissa said, please put in the chat box and she can address those with you. So it's now time for our session to begin, and I'd like to hand over to Nick. Thank you, Nick.
Thank you very much, Claire. It's a real pleasure to be here this afternoon, and let me thank the CPA for the invitation to talk to you today. Pressing on. So climate change is a very big and difficult issue, and this is a really good opportunity today just to talk through the challenges it presents to the audit community, the challenges to people who are preparing audit evidence. So I will start with the science and really hopefully demonstrate to you the challenges around the audit evidence and how those need to essentially align with a lot of the sort of realities that we see in our work. So let's just set the scene here. I've been working on climate change policy for more than 20 years. So the discussions we were having, 20 years ago were around that 2100 endpoint. What's it going to be? What the climate going to do? By the time we got to the sort of, the sort of Copenhagen conferences in 2009, 2010, there was a sort of the discussion was really around climate change being 50 years away. We have to do this, we have to do that. As we sit here today, I think we can all agree that climate change is here today. Today, it is today. And it seems to be throwing some real surprises at us, none of those surprises being very good. You only have to look at the recent sort of news on flooding and bushfires and various other things. There's some very unpleasant and unstable things starting to happen in the Earth system, and that sort of sets the scene for the overall scene for today. If you had to pick a subject that was difficult to audit you could possibly imagine, you probably wouldn't go much further than climate change itself, because essentially you have some very key features in it: complexity, uncertainty, high level of materiality, financial, non-financial drivers. They all come together, and I think the discussion for today is really they pose a serious challenge to traditional forms of audit. It's forward-looking, it's high levels of complexity to build into it. So that's the discussion today, and I'm really looking forward to the presenters to see the experts who do this for in the financial sector, what they're going to say about how we actually do this. Just to introduce a few concepts for those who may not be that familiar with sort of the terms that we use. We basically have two climate change comes in 2 buckets. It has a sort of the transition, and that's really about how we get to the sort of the low emission future, how we reduce the emissions of the carbon dioxide into the atmosphere to reduce the overall global heating effect. And that's when you start to talk about science-based targets and pathways and transition and various things like that. On the other side, the other bucket is the physical part, which is really the way in which the change in the climate itself, whether that be rainfall or temperature, starts to drive the actual changes in that people feel and experience in their everyday lives. And that's when you start to talk about terms of adaptation, resilience, acute and chronic, and a whole range of acronyms that are related to the science about concentration pathways and global climate models and damage functions. For us, that's an everyday. These are everyday terms. We use them day in, day out in all of our work. The starting point for this conversation is really about the Paris Agreement. So the Paris Agreement was that, essentially we got to the point we needed to get to in the global society said there was a problem. The important point about the Paris Agreement was that it placed the climate first. So it basically said, we have to limit global warming to below 2 degrees and preferably below 1.5 degrees. That is a very important anchor point because everything else then flows from that. The next statement is, in order to do that, we need to essentially reduce greenhouse gas emissions to 0 by mid-century. So that forms the real, let's call it the iron framework from which everything else is basically derived. I'm going to introduce you quickly to the idea of a map. So we've got external drivers, which are the things that a company and audit body needs to be aware of. And we have the internal response, which are things that an audited body will want to say or do or disclose to the market. So obviously those two things have to align. If you're going to start to run audits and disclose climate risk impacts, they have to be aligned with the external drivers. And that's the thing we're going to build on today. We're just going to use these two internal, external type worlds as our kind of sort of discussion framework. There's a lot of discussion about the complexity of climate science, and basically you can have a lot of long conversations about it, but it really comes down to one simple fact. It's actually just a straight line, and that is the more carbon dioxide we put into the atmosphere, the warmer it's going to get. And it's nearly a straight line. So that drives a concept called the carbon budget. And essentially we've gone through about 600 gigatons of carbon at a rate of 10 gigatons a year, and we've probably got about another 20 years left most. So that's a problem. That's when you start to go, okay, how do we deal with this? What are we going to? What does that mean? What does that mean for a business? What does that mean for an economy? What does that mean for global society? So you can simplify climate change essentially to a straight line. We have to reduce the level of carbon dioxide in the atmosphere. A few other concepts that are worth knowing on that kind of reality alignment is really what we call locked-in damage and non-stationarity. The Earth system, of which we're sort of disturbed by introducing excess carbon dioxide into its atmosphere, has a very, very long inertia. So essentially, even if we turned off all of the emission sources today, we would still see climate change for at least another 20 years, and that's what these two coloured graphs show. That basically that two different emission scenarios, they overlap for the next 20 years. Another feature of them is that if we really do not succeed in reducing levels of emissions, we are on a non-stationary path. So all of the assumptions about stationary risks, about insurance, about all the things that we can kind of assume away or insure away change. Non-stationarity essentially has impacts on ecosystems, that impacts on people, has impacts on livestock and agriculture. Non-stationarity is a problem. So that's another factor that drives the need to stabilize emissions, is that we don't want to be in that non-stationary universe. It'll be quite worrying and damaging to global society. When you go back to the Paris Agreement, essentially what the Paris Agreement then drives the need for a net zero statement. So what you're seeing now is an ever increasing number of nation states and regions signing up to the net zero point in 2050, 2060, mid-century. The current policies don't get us there. The recent pledges and the sort of more optimistic view, we are starting to get towards where we need to get to for the 2-degree constraint, end of century constraint. So again, very important. These have all happened pretty fast. There's been obviously a lot of complexity in the international policy space, and but we're starting to see the right policy frameworks being put in place to at least give us the sort of the chance of getting there. An important development in the whole kind of policy space has been the emergence of the role of the central banks. So again, from the sort of Paris Agreement, the Mark Carneys and the Bloombergs of this world, we now have the Network for Greening the Financial System, which effectively is the G20 Central Banks, and they have recently constructed a number of scenarios around transition. So what they're basically saying is, we, the central banks, see financial stability as being a risk. We, the central banks, think this is how we need to transition to avoid those financial stability risks. This is the economy we see as being the one that will give us financial stability in the long run. So again, it translates the climate science into a much more financial regulatory landscape, and it starts to move it towards the financial risk disclosure and all the more traditional forms of financial audit. A very important development of the NGFS. However, the NGFS does have some real hard lessons in it. Firstly, it envisages a very different energy system to what we have today. So they're talking about essentially, zero emission energy, trillions of dollars worth of cumulative investment required to get us there by mid-century, and also some rather interesting assumptions, things like bioenergy, carbon capture and storage, which effectively just don't exist. We just don't do that now. So you're talking about entirely new types of technology, and as the NGFS say themselves, a lot of the assumptions about financial stability are heavily predicated on the level of ability to deploy these types of technologies. So it's a genuinely, it's quite a scary space when you think about that. We have to invent an entirely new type of technologies, a new sort of sector of technologies to do this, non-trivial. So that's the sort of the outer external drivers, a very quick cascade down through the sort of mechanisms. We're now going to look at the sort of internal responses. So that's the kind of external driver that a company may find itself in. It wants to be able to sort of disclose to investors and shareholders what it's doing. Essentially, then has to look at its governance strategy, risk management, and then maybe the disclosure on the task force in line with the task force for financial disclosures, which will be audited. Oops, excuse me. Disclosure is a difficult balance for those of us who've worked on these types of projects already with clients. The question is, what is being disclosed? I mean, we're talking about risks in sort of 2030, 2040, 2050. Are they risks that will happen, or is the whole point about not getting to there in the first place? So that's quite a live debate. I'm disclosing a risk, but it's not a risk. I'm not going to get there because I'm going to avoid it. That's the kind of point. So what are you disclosing? And then there's a big conversation around disclosing opportunities. You go, well, that's kind of market sensitive, and I don't really want to be sort of announcing to all my competitors, what I'm going to do and how I'm going to do it. So again, it's like, well, what is it you're actually trying to disclose here? And then that brings to the question is, what are the auditors signing off on? The TCFD's got categories such as governance and strategy and risk management. So I know that Terence and Amanda and people are going to talk about that later, but that's an interesting point, is what is it you're actually signing off on, and what confidence can that give to investors? And is it actually the right metric for disclosure? Will it allow investors to form a decision about the viability of this particular company going forward? In terms of the audit challenges, I've taken a rather kind of on the front foot approach here. What we see is really, due to the complexities and difficulties, we see the challenges really being first of all, subjectivity. Climate change is difficult to understand, and people have subjective views about what it will or will not be. So that's the first challenge. The second one is really groupthink. Again, because of the complexity, because of sometimes just the pure sort of scariness of it, people have kind of groupthink ways of doing it. Yes, we'll be able to do X, Y, and Z in the future. Well, that may not be true. And the third one is really about the basis in reality. And I speak to that really in terms of the climate science itself, what the climate science says will or will not happen as well as it can, but also the kind of claims over some of the technologies, noting the NGFS was pretty clear about its assumptions around some of those carbon removal technologies. Do they actually work? Is there any evidence they work now? Will they work in the future? What is it you're actually relying on to maintain viability? So let's just step into the first one, discussion framework on transition. So as an auditor, and I've done a lot of auditing over the last 20 years in various different guises and roles. So subject matter, audit experts and issues, or aspects and issues. So the subject matter, typically you'll deal with in a transition focused audit would be carbon footprints, tons of CO2, net zero commitments, strategies, offsets, carbon offsetting, targets, carbon intensity, scope 3, all those things form the kind of the raw material, the actual material you're working with, the bricks and the mortar of what you're working with. Now, in terms of the audit aspects, so the auditor will need to be looking at asset values. Are these going concerns? How could a carbon price impact on a revenue stream? How could an assumption about a carbon offset cost change the resilience of a business model? So those are quite meaty audit aspects. And then if you step into the sort of right-hand column, I've just bolded a few of the ideas we're going to talk about next about possible issues. The first one's like the assumptions of future market for products and services. As you see from the NGFS slides, you've got some interesting new technologies, and that means the old technologies will fall away. So what does that mean? And then also you've got the evidence to underpin a carbon offset strategy. So a lot of people are saying we'll use carbon offsets. You go, well, okay, you just might want to think about that because there's some quite interesting challenges emerging out of that conversation. So just moving on. Give an example. So this is a well-regarded example of a disclosure from Oil Search from a few years ago. And basically, what Oil Search clearly did was identify what the impacts of the carbon constraints could do to their products and services, and they clearly demonstrated where their particular cost point sits on that merit order. So evidence, external references, good use of metrics, good use of demonstrating the fact that okay, we understand this, that's where we are, this is where our product sits, we think that's a viable position, which again was regarded as a good position in its day, and so congratulate the team that actually worked on that. If we take a slightly different view of it now, look at carbon offsets. So we have a lot of people saying we're going to do carbon offsets, and we go, okay, well, let's just think about it. So let's take a game theory view to start with. So a lot of the point about carbon offsets is that there are lots of potential players emerging who want to use them. There'll be shipping, there's aviation, there's farming, there's steel, there's all sorts of people. So when you start to look at what the NGFS say about the carbon price development, you quickly see that they're starting to assume prices of up to $300 a ton in 2030. So you think, okay, well, firstly, what are those? Well, what they're not is they're not avoided emissions, because in a net zero world there are no avoided emissions. 95% of all of the carbon offsets that exist today are from avoided emissions, so those won't be usable. So you're then left with the carbon dioxide removal, things that physically remove carbon dioxide the atmosphere, take it from the short-term carbon cycle to the long-term carbon cycle. And they're a lot more difficult, a lot more expensive. The question becomes, if you're going to use carbon offsets as a strategy, then what price would you be prepared to pay for them? So who will win the bidding war? So again, as an auditor, if you see a statement, we will use carbon offsets and the price will be $25 a ton out to 2050, I really suspect that needs to be challenged, because I just don't see how that works. Moving from the transition framework to the physical framework now. So again, same model, subject matter, audit aspects and issues. We moved. Subject matter is about global models. It's about climate projections. It's about vulnerability, exposed to extreme events, financial loss. Again, the things we sort of deal with on our clients on a sort of daily basis now. Audit aspects. Again, we're into the asset values, going concern. Ability to employee health and safety is one that often gets overlooked. The viability of operations at exposed locations. Can you actually get your coal into the coal port if there was a storm surge, for example? And then access to insurance is obviously a big one. Again, people assume there'll be insurability, but insurers are only there for a year. Policies can change very fast. So if we step into the right-hand column now, so possible issues, we'll talk about the knowns and unknowns, particularly what we call damage functions, which is really about vulnerability. And we'll also talk about black box models and hostile analytics, which is the science, the concern that science has as to how the science is being used outside of the actual research institutions. So unknowns. Damage functions are central to our understanding of what climate change will do, and they are not very well understood. So a lot of commentary around this. It's basically a lot of our current understanding of the damage of climate change is very, very limited. We really don't have a good handle on what it will do. And the NGFS themselves essentially say they only cover a limited number of risk transmission channels. They don't capture sea level rise and severe weather. Well, those would seem to be quite important. So we only have a partial view of these damage functions. A lot of the challenges we see with our clients is understand the vulnerability they have today. So that's the glass half empty version. You go to the glass half full version. We do know how to do this, and this is an example in the public domain for some work that we helped combat with just 2 years ago now. You can do it if you have sufficient understanding of how systems respond to climate change, what adaptation options are, and you're prepared to do the sort of hard yards and the sort of deep work on the spatial analysis. You can come to some pretty useful information. And this is the output from the CommBank work. Essentially, these are the impacts on agriculture. These are how you can amend it with that adaptation. So glass half full, glass half empty. Things are possible. Islands of knowledge exist, and we can work from those to give useful and decision useful information. But it's not easy, and this is an evolving field. So, not a stupid question. What is this? Obvious answer is it's a black box, because you can't see into it. And that's been a sort of metaphor that we've used in the climate science sort of discussion at the moment in our work across the climate scientists and the ecosystem of users, is that we really do, and for auditors, this could be a serious problem. So you cannot see into this, you don't know what's inside it, you don't know what it's doing, and that's a problem. So we've been pretty vocal about this, and myself and a few other people who work in this sector, the climate researchers at CLEX, which is Andy Pittman and Kristen Jacob and Sarah, and then Tanya Fielder, who's from the University Business School, Sydney Business School, and Kate McKenzie, who's a former Financial Times journalist. We got concerned enough about what we saw as being black box models being deployed, particularly in the sort of investment community, to go, okay, let's just look at this from a point of view of sort of audit, evidence, and pragmatism. A challenge. And essentially what we concluded was that there are potential downsides, unintended consequences of really starting to use the science that you don't really understand. And there's a very big difference between false precision and accuracy. So we're happy to discuss that. We think it's an issue going forward. We think it's something that auditors will have to deal with if they start to see precise numbers about climate impacts, because it doesn't work like that. It has to be done in a different way. Another concept that comes into this is a lot of climate information is open source, and we see that being used. So what we see is basically what we call hostile analytics, and you see this being openly used now. So this European Central Banks done risk analysis for locations in Europe, and you've got quite a number of sort of high-profile startups, Jupiter Intelligence being one of them. There are others that tap into this open source data and start to be able to tell external bodies, external investors, problems at a specific location. So again, that changes the audit balance, because it gives an outside. You're now dealing with a lot of outside information coming into the company rather than just internal to the company. So you can be challenged externally by a completely third party with access to information. So quick summary, transition aspects are about economy, it's about assumptions, it's about scenarios, and it's about what you'll do with those hard to abate sectors. And the physical aspects are really dependent on the climate science. There's very large uncertainties, and you really need to start thinking about spatial risk capability and those type of interdependencies. So that's me. Thank you very much. Thanks for your time. Over to the next presenter. I think it's Terence. Thank you.
Great. Thanks, Nick. If we can move to the next slide. And apologies for turning up slightly late. I was presenting to an audit committee and it went over time, as they always do. So I'm going to talk through what do auditors need to know, but from a subject matter point of view. And then Amanda will pick up on the financial audit, relying on some of the subject matter assessment. But in taking you through that, I'll also take you through some of the results of some recent research that we've done in terms of what is available in corporate disclosure around climate risk. So if we go to the next slide. Nick has taken you through much of this, but there's a lot going on from an investor point of view, from a legal point of view, and from the point of view of community and government and policy around climate change. And every day there's major announcements. I guess the latest couple of major announcements around this are the European carbon border adjustment that they announced starting 2023, which just means that there'll be a border price adjustment for things that are imported into Europe with a heavier carbon intensity than what they have. And secondly, the Chinese emission trading scheme being imminent to start. Now, I think I can control the slides. Yeah, I can. Right, there we go. Okay. The other aspect to note is the physical impacts of climate change that Nick's talked through. This is just a slide illustrating the financial consequence from an insurance loss perspective that continue to rise over the years from extreme weather events and catastrophic losses as a consequence. Nick's taking you through the TCFD framework, which came out in 2017, and that's really the main framework globally being used, and the research that we've done is against the TCFD framework and disclosure on climate risk associated with it. So again, a bit of this is covered, but it's important to understand, I guess, that risk from a audit point of view can be physical, which can be acute or chronic. So the Commonwealth Bank example has some chronic risks of physical climate change, of what it might have as an impact on the agricultural sector over time, for example, whereas an acute risk might be the catastrophic event graph that I put up, where you might have a bushfire event and that might you might end up losing some assets as a result. And then you've got the transitional risk of adjusting to a carbon price and considering the whole value chain in how that carbon price might impact the way you do business and the business that you're in. TCFD, when you break it down, looks like this. So reporting against the governance strategy around managing those risks, the risk management process, and then the metrics and targets that are associated with measuring and reporting against that risk. And there's more detail in the TCFD documents. I won't go into that, but we will be covering TCFD a fair bit. So this is the research that I mentioned, which is looking at 1,100 companies. It's just been completed across the world by EY, and really looking at climate risk disclosure from publicly listed companies globally and how that's going. And I guess relevance to this discussion is that if the disclosure isn't good, then the audit quality is going to suffer as a result. And I guess what I'll take you through, and hopefully what you get out of this, is that there's still gaps in the disclosure, which means that the auditors need to be asking more questions around these disclosures. So if we look at overall across the 1,100 companies, and we look at two dimensions. One is the quality of disclosure, and the second is coverage. So coverage looks at coverage across the TCFD areas that I went through: governance, strategy, metrics, and risk management. And quality is the depth of coverage of that particular area. And so when you look at it, 70% on coverage. So people are trying to, I think, tick boxes effectively, ensuring that the coverage is done. But the quality of disclosure is still under 50%. It's improved from previous years, but still low. And then if you look at the four areas of TCFD, governance, strategy, risk management, and targets and metrics, again, coverage is good, particularly quality around strategy of how to abate these risks is quite low, under 40%. So that's the overall picture. If we then look at sectors, we've looked at financial sectors versus non-financial sectors. Financial sectors generally is performing lower than non-financial sectors. And then if we look across the industries, if you look at the darker bits of those graphical illustrations, the dark green and the medium green, you'd start to see that banks, energy, telcos are better than some of the others. So if you're auditing, for example, asset owners and managers, you should be concerned about the quality of disclosure in their 25%. So that's just to give you a feel of, depending on which type of sector that you're looking at, the sort of disclosures that we're seeing around the world. There's more information if you want to get onto the EY website, the report's there, and you can get onto Australian sort of specific disclosure in there. If we look at countries across the world, again, UK, Japan, USA, and Europe are leading, and Oceania is right up there. But then Asian, as expected, I think Asian sort of reporting is still way behind. So that's sort of a country by country coverage of disclosures. And if we delve a little bit deeper into scenario analysis, and Nick talked about looking at different scenarios, so looking at the future impact of climate change and looking at scenarios, you start to look at physical risk context. That's the top line. What sort of emission scenarios are we looking at? RCP 8.5 being the worst. So of these, what are the most common scenarios used? So a lot of people are using the worst case scenarios. And what are the time horizons that people have looked at? 2030 being the most common, because there's a lot of talk about 2050 net zero, and a lot of countries setting up 2050 net zero targets, and 2030 being the interim point of that trajectory. And so 2030 and 2050 as time horizons being looked at. 59% of organizations did not mention scenario analysis. So again, a question for auditors will be, if you looked at different scenarios in terms of impact on the business. If we look at then the risk, addressing risk as part of this, 55% looked at physical risk, 25% transition, and 20% both. And the most common risks that were looked at from a physical risk point of view are on the top graph. And then you've got some of the opportunities, physical and transition. So market and acute weather and extreme weather are some of the common risks, and floods that were looked at. And then opportunities, because the TCFD also says, well, if you're a business that you're going to benefit or it's going to have a positive impact on your business from climate change, you should talk to that. Products and services are the ones that got the most mention. So what do the findings tell us? So the three main takeaways from the findings: reporting should connect better with risk and opportunity. So there's still a bit of a disconnect between the disclosures and what really the risk or the opportunity is for that business model. Scenarios we've talked about. So scenarios are important as part of this analysis, and there's not enough scenario analysis. And finally, the biggest emission reduction levers in the value chain should be identified. So some are identifying Scope 1, Scope 2 emissions when they may actually have most of their emissions and risk within Scope 3 emission source, which may impact them down the track. So in terms of, I guess, what we would say to business, all organizations should consider the extent of risk and opportunity from climate change. And they should then look at what those means to the business strategy, and how they should start to address that from a decarbonisation perspective. And finally, how do we disclose that to the market? So that would be what we would suggest to the market. Now, if we look at the top 100 in the ASX, most are starting to do this. But if we start to look at beyond 100, beyond 150 in particular, there's very little consideration of climate impacts to strategy and business model. Now, Amanda's going to talk a little bit more to this, so I won't go through this in detail, but there's quite a bit of a number of opinions and regulatory speeches around climate impact, and particularly the need for disclosure and management of climate risk from a board liability point of view, particularly the Noel Hutley QC opinions. There have been 3 opinions put out so far. There's also a number of legal cases, legal precedents being set, including the latest one, which is not there, which was for Shell to look at their Scope 3 emissions and reduce them by 45%. So there's a number of lawsuits that are also setting precedents, and a number of shareholder resolutions as well. I will not tackle this because that's going to be tackled in the next one, but there is a practice note connecting the subject matter through to what auditors need to look at, and again, this is also going to be covered in the next talk, but effectively the sorts of things that we're starting to see that auditors need to look at from a climate point of view. I think I'm going backwards. The only other thing I was going to mention, because the Australian market isn't using this Sustainability Accounting Standards Board metrics as much as, say, the US and Europe. The SASB guidance, and Australia's talked a lot about GRI over the years, but SASB guidance, effectively, the metrics that SASB produces includes all the metrics that's needed from a metrics and target point of view for TCFD disclosure. So if an organization is doing TCFD disclosure, you can go to the sector and the business type within the SASB reporting suite and work out which metrics you need to report. So that's just worth keeping in mind for that metrics and targets component of TCFD reporting. The final slide, second last, is just to go through, I guess, how we think about from a subject matter point of view, the business model, its climate change impact and financial consequence. So we look at the sensitivity of the business to climate impact and the exposure that the business may have. We then start to work with the business to look at the business continuity aspect, which is a recovery time, and the management contingency that the business may have. That then goes into, well, what are the potential financial impacts? What are the controls? And what's the insurance? And what are some of the additional time-related costs that are impacting the business as a result? And that then flows on to the potential financial consequence and a risk rating. So that's really the continuum to think about climate, both transition risk and physical risk, through to potential for a balance sheet impact. Now, EY generally documents a conclusion on the identified climate-related risks and whether they've been adequately addressed in the audit of the financial statements, including the impact on auditors' report and communications with management. And in particular, we look at some priority sectors when we have a file note, which is financial, wealth and asset management, banks, insurance, as well as energy, materials, ag, and food and forestry products. Those that either have a transition and or a physical risk impact in the short to medium term. This is a really good roadmap in terms of disclosure for a company. So if the company that you're auditing is not doing proper disclosure, it's one of those companies that lack coverage and lack the quality of disclosure, looking at a gap analysis against TCFD, doing some peer benchmarking to see what peers are saying, because that'll give you a sense of what the risks are in the sector, identifying those risks, assessing them from a climate change point of view, and then disclosing the metrics and targets using something like SASB, and then some commentary, management commentary around it. That's me. Passing on to Amanda.
Hi, it's actually me, Caitlin, who's going to be taking over. Thanks for that, Terence. Hi, everyone. Just to reintroduce myself, my name's Caitlin Bonata. I'm a director at PwC. I work in sustainability with clients and particularly focus a lot on financial reporting aspects. So today we're going to kind of talk you through what are the things you need to think about from a financial reporting perspective and auditing financial statements. And after all this information that we've heard from Terence and Nick, what does that actually mean? It's all quite daunting. There's the non-financial information that Terence and Nick have been through, and then there's the financial information in the financial statement, which has to be audited. And so let's talk now about a little kind of a process that we would go through to understand what it is that actually needs to be audited by the financial statement auditors, which other parts of it, some can have assurance, but not always part of the audit, and often assurance is provided by other auditors, and how they both tie in together. Okay, so starting off, let's have a think about what accounting standards say about climate risk. Now, there isn't a lot of specific guidance in the financial accounting standards around climate risk specifically. However, what we are finding as we work through the impacts of climate change with our clients is that a lot of it is already covered in other accounting standards. So I saw a question come up in the Q&A around, are we likely to see another accounting standard for climate change? Well, we are potentially likely to. However, I think there is general consensus for the time being that a lot of the areas that we need to discuss for now are covered in the existing accounting standards around fair value measurement, impairment, provisions and contingencies. And it's just figuring out how to apply those judgments for such complex areas and how to know when to start and where to start, given all the information that we've just seen is out there and the complexity around it. So given the increasing prevalence around physical risk and opportunities and risks associated with transitioning to a lower carbon economy, we can see that there is a potential impact for financial statements in relation to estimates and judgments for assumptions. So as part of that, companies do need to consider how that applies to IFRS standard. Just as a reminder, if information is material and an assessment needs to be done on what is material, and we'll actually go through that in a couple of slides coming up. But what we need to make the assessment of, even though something may seem like it's not material once we look into it, we need to make sure that we've explained it to an extent that it's clear that it's not material, and more importantly, that we've done the work to validate that some of these things aren't material, if that is in fact the situation. So the AASB and the AUASB have released a joint bulletin, and this is looking at materiality considerations around climate change and other emerging risks. So we'll go through some of that, and it's looking at assessing financial statement materiality using the AASB and IASB practice statement too. In addition, the IFRS Foundation have published an in-brief, and that really is quite similar to the AASB and AUASB joint bulletin around what we need to consider within the financial statements. And there's also some educational material that's been released by IFRS, and it's just material which really complements that in brief article. Okay, so if we move on then, let's have a think about where to start as an auditor. So before we jump into some real life examples, let's talk kind of how we work through these issues. So we've got a diagram here which will help simplify the process in a way, if that's possible, and give you a bit of a kind of a framework of how do you start thinking through, how do you know what you don't know effectively, which is the big challenge that auditors are now facing. So the first thing is thinking about investor expectations. So Terence and Nick both touched on this, but in summary, there is a lot of expectation out there from investors, but if you have clients that don't have investors, there's other stakeholders, could be suppliers, owners, the general public. There's a lot of demand around what are the expectations on climate change, and kind of sitting back and doing nothing isn't really an acceptable approach these days. And so it's really getting a clear understanding of what your users of the financial statements and stakeholders are expecting. Use the guidance that we're going through with the AASB and the AUASB to help you understand. And then, as we've said, it's highly unlikely that there won't be any impact at all, or there won't be any perceived potential impact at all. So first, go through and read everything about your client, everything about your client's industry. So a lot of clients have individual kind of TCFD disclosures, as Terence has been through, or climate change reports. If your clients have those, they're the best place to start reading, to start to think about, well, what is the impact on the financial statements? And remember, the purpose of what we're doing here is bringing together the front half and the back half. So the non-financial statements together with the financial statements. It has to be seamless. There have to be things that are disclosed, you know, net zero targets, commitments, risks, opportunities. They all need to link, where applicable, through to the financial statements, and they can't be separate publications that haven't been looked at with the one set of eyes. If your clients don't have any of those reports, if they're perhaps smaller or, you know, earlier in their journey, have a look at their peers and see what their peers are disclosing at the risks, and start having these conversations with clients around, you haven't done anything, why haven't you done anything, pushing back, knowing through information that you might receive from looking at their peers' information that there actually are some risks out there that should be addressed. Based on that, then go to the key financial reporting assumptions. So this is really the crux of what we need to look at within the financial statement, which is the key estimates and judgments that go into the assumptions within our financial statements. So that might be around impairment, it might be around provisions and contingencies, you know, asset valuations, lives of assets, potential liabilities. If you're a bank, potentially expected credit loss models. All of these types of things have estimates and judgments that will most likely in some way be impacted by climate change. Now, it's our responsibility as auditors to understand how the mechanics of that work, to be able to then validate. And if you feel like you can't validate because it's so complex, and a lot of this is, then how do you know when you need to bring someone else in who is an expert? Then it's important to obviously determine the risk of material misstatement as a result of climate risk. And then how is that going to impact your audit? Consider whether this needs to be a key audit matter and who you need to bring in and when. I think the other thing that's really important to understand is that there needs to be clear documentation of this, because what we will find, I think, is that as we go into the next reporting season, it may come across as though there aren't huge impacts in financial statements for a lot of companies because of climate change. Now, that doesn't mean they haven't done a huge amount of work to validate that. And it's really important that where someone is claiming within their disclosures that there's no impact, that is validated through work that's been performed by management. Okay, so what are the standards that are guiding us through the work that needs to be done as auditors? Well, so the first thing to consider is that climate-related and other emerging risks needs to form part of your risk assessment. So applying ASA 315. That's a really key upfront piece of work that needs to be undertaken, and then apply that to what is the risk of material misstatement to ensure that you're responding appropriately to the risk of material misstatement. Then consider the risks and other emerging risks around relevant accounting standards, as I've been through looking at ASA 540, auditing accounting estimates and related disclosures. And the next big one is around ASA 720, the auditor's responsibilities relating to other information. So we'll talk a little bit about that now on the next slide. The other information is actually quite key in this. Now it is for everything. However, for climate change, as I mentioned earlier, there's a lot of other information out there in these sustainability and climate change reports, in the operating reviews, in the risk management sections of the annual reports. And you're going to be hard pressed to find some that don't mention climate. So what is it is our responsibility as auditors that we have to cover off on as part of that? Now, those aren't getting audited as part of the financial statement audits, but it is our responsibility to make sure under IAS 720 that other information is limited to considering whether there is a material inconsistency between other information and the financial statements and other information that's been obtained throughout the audit. So what that means is if there's something in there around we have spent X dollars invested into emerging technologies as part of our pathway to net zero, making sure that that's actually supported and backed up where it needs to be. Amanda's going to step through some of the specific accounting standards that we'll go through and where those will be considered. But what we will find is that there's not always going to be an impact on this year's financial statements, given the time period that the financial statements extend to, being 12 months to maybe 5 years through certain asset valuations and cash flow projections. So it's really understanding that there's not always going to be an impact on every single thing in the financials, but that doesn't necessarily mean it doesn't need to be disclosed. And let's talk about why. So in the next slide here, we're talking about the AASB and AUASB joint bulletin. And that's talking about basically where investor expectation is that climate-related or other emerging risks affect entities qualitatively or quantitatively, that has been disclosed. And so even if it's qualitatively and you've done the work and you've assessed that there's no quantitative impact, then that needs to be validated and potentially explained. In other words, is there an impact of climate change because people think there could be? No, there's not, because we've done the work behind to validate it. But because people think there could be, we need to explain that and disclose it in our financial statements. And I think that's really important as part of this going through as auditors. And this is really the type of materiality assessment you need to do for some of these factors. Okay, that's it for me now. Amanda's going to start going through, as I said, certain industries that are probably more highly exposed, and then some accounting considerations that need to be considered.
Oh, you're very quiet, Amanda. Sorry, I'm just jumping in there.
That would help. Can you hear me better now?
That's great.
Let me start again. What I'm going to go through today, as Caitlin said, is some more specifics about in the financial statements, in what line items we could see impacts as a result of climate change. So just quickly on this slide, just to highlight again, to help you identify whether a company is in an impacted industry, this TCFD has identified the sectors in the table in this slide as those expected to be the most impacted by climate-related risks. And it's not an exhaustive list, and there could be other sectors that may be impacted, but as an auditor, it's a good point when you're just doing, as Caitlin said, going through that sort of risk assessment for your client, thinking about if it falls within one of those sectors. But remember, every company is different. And so the ones in here which are, certain industries that are more likely to be directly impact are those that rely on mining, refining or burning fossil fuels, those that rely on climate conditions for sufficient agricultural yields, or those that ensure finance or invest in entities that are impacted by climate change. But just an important thing to remember, even if it's not a directly impacted industry, its operations may be indirectly affected. For example, its supply chain could be impacted by climate change. So this slide here, quite a busy slide, but it touches on the potential financial implications of climate change. And as you can see, it's really fairly broad. I would again reiterate, it's very company and industry specific, so don't think that every single thing on this list would impact a company. But what I might do now, or what I will go through, is some specific items where we have seen or would expect to see some impacts if a client is in an impacted industry. Okay, so the first one is impairment of non-financial assets. So let's think about some ways that climate change could affect an entity's impairment models. So the first thing is that climate change could be an indicator of impairment and trigger the need for an impairment test. So, for example, a decline in demand for products that emit greenhouse gases could indicate that a manufacturing plant may be impaired, or the introduction of new legislation could cause a company to reassess the viability of a product line, or result in the imposition of new costs, triggering the need to test associated assets for impairment. Engaging in activities that are seen as potentially damaging to the environment could result in reputational damage, loss of customers, and could impact the value of brands and trademarks along with other intangibles. And voluntary environmental commitments that the company has made may also need to be taken into account. For example, a commitment to discontinue a product line or decarbonise its operations could be an indicator of impairment. And this is one of the reasons why a finance team should be aware of the company's plans and commitments with respect to climate change. And as Caitlin mentioned before, again, it's sort of understanding what a client would be saying or company would be saying in its sustainability report and ESG reporting, and then thinking about how that could impact the financial statements. So the second one I would highlight here is impacts to the cash flows in a value and use model. So this could be an adjustment to a forecast income expected to be generated from an asset, or changes to an entity's cost base. So for instance, there might be a change in the costs directly related to carbon pricing, the costs of input into production, or even overheads such as rises in insurance premiums in areas exposed to physical climate risks. And an entity may need to make judgments about the extent to which it can pass price increases onto its customers. So another thing to think about on impairment is the impact on the length of the cash flow forecast period and the terminal growth rate assumptions. So this may be particularly relevant in looking at assets in energy intensive industries. And typically impairment models have tended to assume positive growth rates at the rate of long-term inflation. However, for certain industries, a negative growth rate or a finite forecast period may be necessary. And as Caitlin mentioned, promises a company makes in its ESG or integrated reports may need to be reviewed and could result in changes in the cash flow forecasts to the extent there needs to be consistency between the assumptions underlying the financial statements and the plans laid out in the company's sustainability reporting. And the other thing I would highlight on here is impairment disclosures, and this is really important. So any climate-related impacts need to be explained, and where climate-related risks could have a significant impact on a company's operations, information about how this has been factored into the recoverable amount calculations would be relevant for the users of financial statements. And investors, as we've heard from all of our presenters so far, are putting more pressure on companies, and they're putting more pressure on companies to ditch boilerplate disclosures in favour of really specific, tangible analysis of the company's exposure to climate risk and how it impacts a company. And in some cases, the conclusion not to just an impairment model for climate risk may be based on significant judgments or assumptions that entities should reflect in their financial statement disclosures. So again, linking into what Caitlin mentioned before on materiality. Now, I would say, and we've heard this a couple of times, that impacts needn't all be negative. So climate change presents, both risks and opportunities for entities. But I would caution that in a value and use method, when you're doing impairment testing, this requires an entity to apply strict limits on when benefits of restructuring and improvements or investment in an asset's enhanced performance can be taken into account. And these benefits can only be reflected in a value and use calculation once an entity is committed to the restructuring. But if an entity uses a market-based measure of fair value in determining the fair value less cost of disposal, it's important to keep in mind that market participants may already have climate risk based it into the accounting in determining the fair value. And to the extent this is the case, it would already be reflected in reference points used in the market approach, and so no adjustment would be needed. So a lot of information there. Let's get a bit more practical and illustrate these concepts with a couple of examples. So let's touch on firstly the impact of legislation. So let's say we've got a group that operates in an energy intensive industry and the ongoing viability of their product is considered to be stable. However, the management team have noted it is likely that the continued creation of carbon emissions will likely attract more cost in the future through a carbon tax. So as a result of this, the management team have updated their cash flow forecasts used as a basis for the terminal value in their value and use impairment model to reduce the operating margin by 1% to factor in the incremental cost expected for acquiring additional carbon emission credits. So another example, if we think about the impact on cash flow projections. So let's just say in this example, we've got a supermarket retail group and it's made a promise to its customers that in 3 years' time, all of its own branded products will only be sourced from carbon neutral certified farms. And management expects that will increase the input costs by 5% and that only 3% price increase for its products would be viable. And if this is the case, management will need to adjust the gross margin in their forecast models down by 2% in each period affected. And the last one on this would be the benefits of a restructuring. So if a company, for example, in the transport industry develops a plan to invest in a low emission fleet in response to new legislation targeting carbon intensive freight, and so at the year end, the company could still be assessing a range of options which would be estimated to reduce its cost base by between 15 to 20% compared to maintaining its existing fleet. And at the year end, the company is also reviewing its annual goodwill impairment model in the context of the new legislation and the options that are available to it. Unfortunately, in this example, the company would not be able to take into account the expected benefit of the potential improvements in a value and use model. A fair value less cost of disposal model may need to be used if it is reasonable to expect another company that is a market participant could also take advantage of the cost reductions by investing in a more carbon efficient fleet. So as you can see from that, there's a lot to think about when it comes to impairment testing and IAS 36, and it's really worth just investing the time and thinking through very specifically on your client if it will have an impact. So I might quickly cover on next another area which could be the recoverability of other assets. So in addition to impairment, the useful lives and residual values of plant and equipment and intangible assets may need to be reassessed as a result of climate change. For example, climate impacts could result in earlier obsolescence of assets, so you may need to accelerate the depreciation in that example. The recoverability of deferred tax assets could also come into question for similar reasons as we discussed when considering impairment of non-financial assets. Deferred tax assets are recognised to the extent that it is probable an entity will generate future taxable profits. And climate change might impact a company's estimates of the future taxable profits and result in it not being able to recognise deferred tax assets or lead to it being derecognised earlier than previously thought. I do mention on here inventories, and they could become impaired if they're not recoverable. But I would say if a company has a frequent inventory turnover, this may not be an issue. So moving on to another topic, provisions and contingent liabilities. So on that liability side of the balance sheet, climate risk can have an impact on the recognition, measurement and disclosure of provisions, and it could impact restructuring provisions and environmental or decommissioning obligations. And actions taken or statements made by an entity could give rise to a constructive obligation for which provisions must be recognised, even in the absence of legislation requiring the entity to take action. So for obligations arising from new legislation, it's important to remember the requirement that a provision would be recognised only when the legislation is substantively enacted. And in many cases, this will not occur until the law is actually passed and becomes legislation. So let's illustrate a few examples of this using a decommissioning provision. So let's say we've got a company that operates a plant that is heavily dependent on fossil fuels and for which it has recognised a decommissioning provision. And the sustainability strategy, as Caitlin mentioned before, promises carbon neutrality by 2030. And this can realistically only be achieved by substituting the plant with a newer hybrid model plant in the midterm, sooner than originally anticipated. And it may be possible to substitute and decommission the plant somewhat later than 2030, but it would require the purchase of carbon offsetting credits in the meantime. So as a result of this plan, the company must bring forward the timing of the expected cash flows for decommissioning the plant due to the earlier decommissioning of the plant than originally envisaged when the provision was first recognised. And so in this case, the company brought forward its decommissioning voluntarily. The public statements it made in its sustainability strategy triggered a reassessment of when this would need to take place. Now, those are just a few key topics that I've hit on. There's many more than that. And in banking in particular, there's impacts from expected credit losses and green loans, and also the accounting for emission trading schemes. Those are all very complex, and I've not gone through them now. But if your client or if the company that you work in does have those would take some extra consideration. Now, I'm very conscious of time, so I'll just quickly flick through my last slide here, which is just on disclosure about judgments and assumptions. And we've heard, I think, all of us today talk about the importance of that. And what I'm just going to mention again here is the importance of that in the financial report, and just ensuring that the user and the reader of your accounts really understands the impact of climate change, if it is material, and what the impact is. And if a company doesn't think it's material, it's really important to clearly state that as well. So that's all from me today. I might just hand back to Claire now.
Thank you very much, Amanda, and thank you to all of our speakers. We are going to have a panel discussion now. And I know we've got a couple of questions that have come through, but I encourage you all to pop your questions in the Q&A box. I've got lots of questions to ask as well, but I'll keep an eye out for questions coming through from the audience. And I'd actually like to jump to a question that has come through from the audience. If all the panelists would like to turn their cameras on, that would be fantastic. But this one's actually for you, Amanda. I wanted to put it to you straight away because it related to what you were just talking about. So impairments. And the question is, on impairments, my understanding is that factors which need to be incorporated need to be reasonably foreseeable. Can you talk about how you anticipate organisations factor that in, given the uncertainty of timing and scale of climate-related impacts? Thanks, Amanda.
So what we are seeing, and I might get Caitlin to jump in on this as well, about what we are seeing companies do in terms of scenario analysis. And I know Terence mentioned that as well. And I think what companies have got to work out is what they think the most likely scenario is going to be for them, that is the most likely outcome for it to be in the future. That is the one that they would model in their impairment. But again, companies making disclosure around, well, what that is, and then also maybe modeling out what another scenario could be, and disclosing what the impact of that would be.
I'll also jump in on that one. This is something I've been working a lot with at the moment. So part of the TCFD disclosures requires several scenario analysis, and that is under different temperature outcomes. So you may have a Paris-aligned scenario, which is how resilient is our business if there's a Paris-aligned world? How resilient is our business under the current trajectory? And that the current trajectory, which is often what clients are seeing as the most plausible from an accounting perspective, because this considers publicly announced legislation and technologies. And so as Nick was going through, a lot of the technologies haven't even been invented yet. However, there are so many scenarios out there that include evolving technologies. And it's a really big challenge for companies to understand, okay, well, what does it mean that I need to include in my impairments? Because we are seeing increasing pressure from investors who are saying, we want to see Paris-aligned financial statements. And there's several big companies, listed companies globally, who have received, letters and demands from very material investor groups saying, we want to see your financial statements under a Paris-aligned scenario. Now, Paris-aligned scenario, for most people, I won't try and speak for everyone, but it's generally acknowledged that we've almost reached the point of no return for Paris-aligned, which is very depressing. The IEA has recently come out and said there is, for the first time now, a glimmer of hope. However, there are some fairly aggressive assumptions that need to be applied to get there. So the question is, how do you respond to investors who are saying we want Paris-aligned, but that doesn't fit in the accounting standards, because the accounting standards in your financial statements need to be presented under a most plausible, future of your assets. And so therefore you can't technically do it under a scenario that is unlikely to happen. However, yet you'll still have these scenarios presented in your accounts through your TCFD disclosures. So it's a very big balancing act, and a lot of the time we've seen a lot of companies come out and put statements in their annual reports, and mostly it's been in the front half. We have started to see some come out in things like basis of preparation, where they're saying currently, as much as we want it to be the case, 1.5 isn't management's most plausible outcome. Therefore, our impairment calculations, for example, are done under our middle scenario.
Thanks very much, Caitlin. I'm wondering whether, leading on from that, we're talking about that scenario analysis, and so I thought I might jump to you, Terence. How does an entity and their auditor apply scenarios when the results of the different scenarios are really a broad range of outcomes? Do you have any tips on how to deal with that and which scenario to pick in terms of reflecting those?
Yeah, so the best way to answer that is, again, going back to the two types of risks. So you've got the transition risk and the physical risk. A high emission scenario, and Nick put up some graphs around this, presents worst case physical risks, but lower transition risk because you're allowed to continue to emit. Whereas a lower emission scenario, less of a physical risk going forward, but the world's moving to a lower carbon economy quicker, and so the transition impact is higher. So what we normally suggest to clients is to look at the worst case scenarios on both those fronts, and if they then need to have a look at additional scenarios. So if you look at physical impacts, there isn't a whole lot of change looking at the different scenarios over the next 30 years. So you'd go the high emission scenario, And for transition, depending on the business that you're in, you might want to look at a few different scenarios. The other important thing to remember is that TCFD guidance is very specific about not cherry picking scenarios, so not picking a scenario that works for you. So this is where you've got to start to look at worst case and to present that to the market, particularly if you know the outcomes, so without withholding information. So yeah, that's what my advice would be, to look at worst case scenarios and then start to pare back to see whether additional scenarios are needed.
Yeah, thanks, Terence. So that sort of leads me on to a question for Nick, in that, so grappling with these scenarios, how do you think companies can be ready for the auditors' questions around this, of how they can justify different scenarios that they have selected to reflect in the financial information?
Yeah, thank you, Claire. It's difficult. I think the capabilities are not even close to being developed yet. So if you start to keep an eye on things like what the central banks are saying, they're starting to talk about the need for a very good understanding of spatial risk. So, for example, 101 is, where are all your assets? So that's a starting point. So if you're a big global business with hundreds and possibly thousands of actual physical assets, you really should know where all of them are on an absolutely long spatial basis. So that forms a good basis of preparation for an audit, because then you can start to point to evidence that you've done the work and you understand it. Another one would be on the sort of transition risks piece. People talk about physical and transition being separate, but there are things that connect them, and one of them is actually insurance. So you go, okay, well, transition is not a very a bad physical outcome is a good transition outcome, but not if you haven't got any insurance. So I think, again, it's a start to go, have you really tested in your risk assessment all of these aspects, and have you documented all of that, and can you point to external sources of evidence that support what you're saying? It's really, we're back to the basics. Get the evidence, make sure the evidence makes sense, and then make sure that is put forward in a format that is auditable. Auditable climate information is very difficult, and I really don't think we've actually got the software tools or the kind of understanding of how you audit big, complex climate information systems. We have some ideas, but we're not there yet. Thanks.
Thanks, Nick. And I might just turn to some more questions that are coming through from the chat. One of the questions from Simon is, most of the discussion today has been around private sector industry approach to climate risks and disclosures. So do any of the panelists have any thoughts or views on how the government or public sector entities should be approaching climate risk management in their operations, and some of the differences that might exist with this approach compared to private industry sectors? I don't know if I can you'd be happy to take that, Terence. Thanks, Terence.
Given that I just came off that audit committee, which is the public sector audit committee meeting on climate change. What we're seeing are, in some state governments, some requirements being placed through ministerial obligations, particularly for climate sensitive sectors around climate risk. So there are some obligations being placed. If there aren't any obligations and you're an outer budget agency and you've got your own budget, our recommendation is to start to think about climate risk just as you would as a private company, because obligations are most likely coming. It's probably to do with politics more than anything else, and it's probably on its way. And it's good management practice anyway. The final thing I'd say is that the Noel Hutley opinion around climate risk applies to both private and public sector directors. So if you're a director of a water company, you still have a legal liability to consider climate risk in the way you look at discharging your duties.
Thanks, Terence. We've also got a question for Caitlin. Now, it was in the context of your previous answer, and I'm trying to put this in context, but I'll read it out and hopefully you can put it in the context of the previous answer. So it's saying that, thanks, Caitlin, that's useful. Sounds like it also speaks to the difference between scenarios. those intended to be divergent, challenging, etc., and a forecast, and the different purposes and uses of the two?
Yes. So that's correct, because basically scenarios, there are infinite number of scenarios. A scenario is a way that we get to a certain climate outcome, and it might be through various different approaches. It might rely heavily on, certain technologies. It might rely on everyone becoming vegan. It might rely there are so many different scenarios out there. Now, no one scenario, I mean, I'm not a statistician, but it's unlikely that any one scenario will ever be 100% kind of rolled out exactly as the scenario applies. So that's not necessarily going to guide your accounting estimates and judgments. Now, what you need to do is to say, okay, whether we have our most plausible scenario includes various assumptions as disclosed within our scenario. And therefore, if we apply those same assumptions to our, let's say, cash flows that might impact, let's just say, commodity price, for example, because we're relying on a higher level of electrification of vehicles, and therefore, what does this do to our products? So what I'm saying is, you're not going to be exactly able to apply your scenario to your prices. You're going to have to apply the assumptions within your scenarios as accurately as possible to the relevant factors within your cash flows and forecasts and fair value and strategy. And it's not an easy exercise, and it's never going to necessarily be exact. And this is where the challenge comes out. It's because there needs to be some consistency there. If you're saying our most plausible scenario assumes all of these factors occur, and then within your impairment assumptions and estimates, you have different assumptions, that's not going to be appropriate. And so it's really matching them up with the knowledge that you'll never be able to match them exactly. And in fact, a lot of companies come out and say, no one scenario, none of our scenarios are likely to happen exactly. However, we see our most plausible scenario as being X, and these assumptions have driven our estimates and key estimates and judgments. So I hope that answers the question.
Yeah, great. Thanks very much, Caitlin. We've got a question here that I want to put to you, Amanda. It says, is it possible that accounting standards can change to suit climate-related impacts, or how those climate-related impacts are reported in the financial statements? They mention IFRS 16. I know that's not one of the standards that you mentioned in your slide, but do you sort of see in the future that accounting standards would need to adjust to address climate risk?
Sure, happy to take that question. And Caitlin sort of touched on it previously before. So the impacts that I talked through before in that slide that I had it with the potential impacts. So those are all within existing accounting standards. So at the minute, all of these impacts could be in existing accounting standards. There could be, I think what could happen is some standards that come in potentially for auditing, for accounting for non-financial information. I could see a scenario where that could happen. But at the minute, all of the impacts to this are within existing standards.
Yes, brilliant. Thank you, Amanda. I've got a question come through here for you, Nick, and that is regarding UN sustainability guidelines. So it says, where does compliance to UN sustainability guidelines fit into the climate change frameworks and standards?
Hi there, thanks. Difficult at the moment. I think the UN standards are driving things like, they're cascading down to things like sustainable investment, for example. And I think those form of guide. So aspects are the UN is starting to define the outer envelope of the, let's call it, where the world's going to go. They're starting to define through various processes what the investable world looks like. The sustainable investment, the UN PRI, I think they're all very important things to take note of. And but I don't think we've got a fully connected system yet, but I think that's a few years away. Thanks.
Thanks, Nick. And I've got another question for you, actually. So for auditors that are listening in on this webinar in small or mid-tier firms that may not have internal capability to address climate-related risk assessment and scenario analysis, where do you think that auditors can go to find those experts and test out the risks and how they're adequately reflected in the financials?
Interesting. So obviously there's a consultancy sector. I mean, I'm sitting in a consultancy office now. There are initiatives underway with things like the CSIRO and their climate resilient mission and various roundtables. So there is definitely, initiatives underway to try and upskill people in all areas of climate risk. So, you can rent in the expertise, you can go and talk to various government agencies, and you can start to talk to the CSIRO and people themselves. But again, I think we're still quite a long way from having a functional educational ecosystem. I know that University of Sydney are trying to build up, non-financial auditing. I think the CPA themselves have got courses of that. So early days, but I think consultancies we know how to do it for starters, and there are others in the sector who do as well. Thanks.
Yeah, thanks, Nick. And yeah, Terence, I was going to actually turn to you on this topic as well. So yeah, from your, how much do auditors need to understand about climate risk and all these issues that we've been talking about today?
Yeah, so if you are in a sort of mid-tier firm and you're not exposed to a larger end of town, I'd probably start to familiarize myself with sessions like this in terms of understanding climate risk. But going to one of the points made earlier, I think it was Mando, Caitlin, around looking at peer reporting. So you might be a small construction company, but you could have a look at a large construction company, sustainability or ESG disclosures, to see what they've done, what scenarios they've looked at, what sort of risks they're talking about, to get a sense of what that sector may be faced with. And the other one that I'd refer to is the SASB materiality map, going into the SASB guidance and having a look at the sector and having a look at the TCFD climate metrics to see what that particular sector may need to consider. That's free.
That's fantastic. Now, I see that we've actually hit 2 o'clock. And whilst I think we could go on for another couple of hours and talk about the details with this, I think we best wrap up there and finish on time. So I would just like to very much thank all of you on the panel for giving your presentations. So Nick, Terence, Caitlin and Amanda, really appreciate the time you've put into this. Huge amount of information and detail there and really great insights. Definitely this is going to be the first of many sessions that we will need to run to get our auditors across all the issues. So again, thank you very much. I'll hand back to Melissa now to wrap up our webinar.
Thank you, Claire, and thanks again to our presenters, and thank you to everyone for your participation today. In the next 3 working days, you'll receive an evaluation survey accompanied by a recording of this webinar. We really appreciate your feedback as it is extremely valuable to CPA Australia to help us deliver better events for you. Thanks again, and we look forward to welcoming you to another CPA Australia webinar soon.
Thank you. Bye.
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 Thanks for your participation. Bye.